This may be the greatest line in Wikipedia's history. Ronald James Reed was an American philanthropist, investor, janitor, and gas station attendant. Reed turned a janitor's salary into an $8 million portfolio. How did he do it? What stocks did he buy? And what 9 lessons can we take away from this extraordinary man?
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
This video is sponsored by you. Thank you to all of my patrons on Patreon and members of the YouTube channel. If you're interested in supporting the channel and getting access to some exclusive content, I'll put a link in the description down below. In 2014, Ronald Reed of Brattleboro, Vermont, died at the age of 92. His friends were shocked when they realized the value of his estate was over $8 million. Reed grew up in Dummerston, Vermont, where he was the first high school graduate in his family. He would walk 4 miles to school each and every day. He served in the United States Army during World War II, and in 1945, he was honorably discharged and retired from the military. He returned to Brattleboro, Vermont, where he served as a gas station attendant and mechanic for 25 years. After that, he retired for 1 year before serving as a part-time janitor for the next 17 years. Despite this obviously modest salary, modest earnings throughout his life, he amassed $8 million. How did he do it? What are the 9 things we can learn from this man's life? The first is that those who appear rich probably aren't, and those who appear poor may not actually be. He was a regular at Friendly's, which was a local coffee shop, where he would go and have a cup of coffee and an English muffin with peanut butter on it. There was one time where a patron of Friendly's actually paid for his meal because they thought he was homeless. When he passed away, he owned a 2007 Toyota Yaris, and his attorney said that whenever he would park away from the parking meters and walk all the way into whatever store he was going to just to save the fee. Meanwhile, he was a millionaire the entire time. His friends, neighbors, and even his own family members had no idea the wealth that he had amassed. The second thing we learned from Reed is to buy what you know. Reed amassed his $8 million fortune, mostly investing in dividend-paying stocks that were simple businesses that he could understand. His attorney, Lori Rowell, said he only invested in what he knew and what paid dividends. That was important to him. He bought stocks like J.M. Smucker, AT&T, John Deere, General Electric, Procter & Gamble, J.P. Morgan Chase, General Motors, and Dow Chemical Company. These were businesses that were easily recognizable, that he bought many of their products. The third thing we learned from Reed is to diversify, but only at the start. When Reed died, he had 95 different stocks in his portfolio, and these were spread out across different industries such as healthcare, industrials, banks, railroads, and telecommunications stocks. The only sector he did not buy was technology, and the reason was because he did not understand it. But everyone knows the importance of diversification, but only the greatest investors do the next thing, which is number 4 on the list. You should diversify at the start, but let your portfolio concentrate itself over time. In other words, let your winners win. At the time of his passing, the stock-only portion of Reed's wealth was worth about $6.8 million spread out across 95 different stocks. However, a third of the value of this portfolio was in just 10 holdings. At the time of his passing, he had roughly $150,000 in United Technologies, Raytheon, McCormick, and VF Corp. He had around $200,000 in Johnson & Johnson, J.M. Smucker, and American Express. Colgate-Palmolive was worth $250,000, Procter & Gamble was worth $364,000, and then his largest holding was Wells Fargo, worth over $500,000 alone. The average value of these 10 holdings would be $228,000 each. Meanwhile, the other 85 holdings would have an average value of just $53,000 each. In other words, Reed's practice was to buy a business that he understood and had a lot of confidence in, and then he would just simply put the stock shares in a safety deposit box and forget about them. The fifth thing we learned from Reed is to reinvest your dividends. Friends of Mr. Reed said that he would only buy companies that paid hefty dividends, and he would plow the dividends back into buying more stock. According to the Wall Street Journal, he purchased 39 shares of Pacific Gas and Electric on January 13th, 1959. Those were worth about $2,380 at the time, or $61 per share. And at the time of his death, the stock price had actually declined on PG&E, but his share count had ballooned to a staggering 578 shares in PG&E. So even though the stock actually dropped to $46 a share at his death, the position was still worth over $26,500. He had invested in this company and reinvested dividends for 65 years. So even though the actual performance was terrible, he still multiplied his initial investment by 10 times. That illustrates the sixth thing we can learn from Mr. Reed, which is that time is more important than returns. A Wall Street Journal article said that besides being a good stock picker, he displayed remarkable frugality and patience, which gave him many years of compounded growth. Those 95 stocks that Mr. Reed owned, many of them he had owned for years and decades even. For example, the PG&E investment only returned 4.5% per year, but that he had done it for 65 years demonstrates the power of time and compound interest. The seventh thing we can learn from Mr. Reed is that you should make it inconvenient for you to sell your stocks. Reed grew up in a time where there were no computers, there was no internet, so he wasn't getting online and buying his stocks at TD Ameritrade or M1 Finance. He was actually buying them directly from the company and getting a stock certificate. He would put those stock certificates in his safety deposit box at the bank. At the time of his death, the stack of those stock certificates was 5 inches tall. This made it extremely difficult and inconvenient for Reed to sell his shares of stocks. He couldn't log into the brokerage account and click a few buttons. He would have to go to the bank, get the stock certificate, convert it into an electronic format, and then sell that to someone else and get the money deposited back into his account before reinvesting in another stock. Since it was so difficult to sell, it's something that he would not have taken very lightly. He only would have sold when it was obvious to him that he should do so. Otherwise, he would just let the shares accumulate in his safety deposit box and be content to hold them essentially forever. Today's investors have immediate access to both the value of their stocks and the ability to sell them at any point in time. I think this is a huge disadvantage to be able to do things so quickly. Mr. Reed is an example of the power of putting something in between you and the sell button. That could be a safety deposit box. It could be making your account impossible to log into online unless you ask your friend for the password. Maybe it's having an advisor that would stand between you and selling your stocks. Make it difficult for yourself to hit the sell button. At least force yourself to give it some thought before you just see that a stock is down and impulsively go in and get rid of it. Number 8 is don't quote your portfolio very often. Reed would have had no access to daily fluctuations in stock prices. He would not have had a Quotron machine, which would have been really expensive. He did not have a computer or the internet. So the only way he saw the market value was if he would maybe call a broker or call an advisor or somebody that had a machine, or he would have to wait until his monthly or quarterly statements from the companies would come in the mail. The less you look at your portfolio, probably the better you're going to do. And the final lesson we learned from Mr. Reed is that mistakes are okay. Mr. Reed did not always hit home runs with his investments. For example, he had invested in Lehman Brothers, which actually went bankrupt in 2008, but he was willing to stick with his picks for many years, many decades, and over time, the big winners from his portfolio offset the mistakes that he made. Mr. Reed is an inspirational story for anyone of any walk of life, of any salary, that you can save enough money and accumulate wealth in the stock market no matter who you are. One of the best things that Mr. Reed did is basically invest in a coffee can portfolio. I'll talk about more of what that is and how you can implement it for yourself in the next video.